Welcome to the real world of startup financing. If you think you can ignore the money side of your startup, think again. The brutal truth is if you run out of cash, your startup dies, game over. Financing is the lifeblood that keeps your business alive and kicking, and beyond survival, it's what lets you scale up to chase big dreams. Now, not every successful company raises money from venture capitalists or angels. Some scrappy founders bootstrap their way to profits, but every founder needs to grasp the rules of the funding game. In this crash course, I'm going to give it to you straight, no sugarcoating. By the end, you'll understand why financing matters, what your options are, and how to navigate the tough calls. Buckle up for some hard truths and practical tips, because it's time to talk about money. So what do we actually mean by startup financing? In plain English, it's getting the money you need to turn your idea into a real, functioning business. Think of cash as the fuel in your tank. Without enough of it, you won't get to your destination. Usually, startups raise that cash by trading a piece of ownership equity to investors in exchange for their money. Basically, you sell a slice of your company in return for dollars today. The other route is debt. Borrowing money you'll have to pay back, but early on. Few banks are crazy enough to lend to a company with no revenue, and you probably can't afford the interest anyway. That's why most early stage founders go the equity route. Investors put in cash, they get stock. And if you succeed, everyone wins. One more thing, some founders choose bootstrapping, meaning they use their own savings or reinvest any revenue to grow with no outside investors. It's slower and tougher, but you keep full control. We'll talk about all these paths as we go. Let's lay out two very different roads, bootstrapping versus raising capital. And bootstrapping means you're funding the startup yourself, maybe from savings or revenue. The upside, you own the whole damn thing, no investors barking in your ear, no dilution of your ownership. And some legendary companies started this way. MailChimp, for instance, never took a dime of venture capital and later sold for $12 billion. Spanx, Sarah Blakely's company, was launched with her $5,000 savings, and she ended up a billionaire with 100% ownership. Sounds great, right? But here's the rub. Without external money, your growth is handcuffed by whatever cash you can scrape together. It might take a lot longer to get big, or you might miss the window in a fast-moving market. Now, raising capital, on the other hand, is like strapping a booster rocket to your startup. You get a big infusion of cash to hire, develop, and blitzscale if needed. Uber and SpaceX wouldn't exist as we know them. Without major outside funding, those businesses needed piles of cash to attack huge opportunities quickly. The trade-off, you give up some ownership, meaning your slice of the pie gets smaller, and investors will now have a say in certain decisions. Neither path is better universally. It's about what fits your goals, your industry, and how quickly you need to move. No moral judgments here, just strategic ones. All right, so if you decide to seek outside money, who exactly can you get it from? There's a whole menu of funding sources, each with flavors of its own. First up, friends and family, the people who already believe in you, or at least tolerate you. Tapping your inner circle can be the quickest way to get initial cash with minimal paperwork. The terms are usually lax. Uncle Bob isn't going to demand a board seat, but remember, this is their money and your dream. If things go south, Thanksgiving dinner could get awkward. Next, we have angel investors. These are wealthy individuals, often ex-entrepreneurs, who invest their own money into startups. They cut smaller checks than VCs, but can be great allies and will bring in advice and contacts along with cash. Now, venture capitalists, the big leagues. VCs manage funds of other people's money and invest millions in high-growth startups. If an angel might give you $50 K to test the waters, a VC could lead a $5 million Series A round to really hit the gas. But VCs don't give without expecting a lot in return. They'll push for aggressive growth, and they usually want a meaningful chunk of your company and often a say in how it's run. Then there's crowdfunding, think Kickstarter, equity crowdfunding platforms. This is where you pitch to the crowd. Hundreds or thousands of regular people chip in a few bucks each to collectively fund you. Crowdfunding can double as marketing. It proves there's public interest, but it's a ton of work to campaign, and you might end up with a lot of small investors to manage. Finally, loans and grants. Traditional bank loans for startups are rare. Banks prefer businesses that can show they'll pay them back reliably. But if you have revenue or assets, it's possible. Just remember you're on the hook to repay loan money regardless of your startup's fate. Grants and competitions, that's essentially free money if you win them, no equity, no repayment. But the competition is fierce and the paperwork can be painful. Bottom line, know your options. The best source for you depends on how much you need, what you're building, and what strings you're willing to deal with. Let's zoom out and see the big picture, the startup funding lifecycle. So it typically goes something like this. Pre-seed and seed rounds are at the very beginning. You've got an idea or a prototype, maybe a little bit of user traction. Pre-seed might just be you begging and borrowing from friends, family, or a couple of angels to get started. or joining an accelerator like Y Combinator for a small check and lots of mentorship. Seed is often the first official round from angel groups or dedicated seed funds. Money to build your MVP minimum viable product, sign on early customers, and prove that your concept actually works in the real world. If you hit those early milestones, next comes Series A. This is usually where the venture capital firms come in big. They write a larger check, say $2 to $10 million, typically to help you scale up, hire more engineers, kick marketing into gear, turn that early promise into real growth. If things go well, then Series B, C, and so on follow, each round injecting more cash to fuel further expansion, maybe new markets, new product lines, and each round usually at a higher valuation than the last. That's the idea anyway. By the time you're raising these later rounds, you might be taking tens of millions, even hundreds in the crazy cases, often from growth stage VCs or even hedge funds or strategic corporate investors. Finally, we have the end game or exit, either an IPO, taking the company public on the stock market, or an acquisition by a bigger company. That's when the investors, and hopefully you get to cash out some or all of your equity. Each stage is like a checkpoint. If you grow and hit targets, you unlock the next level of funding. But if you stall, well, you could be stuck or end up selling the company for scraps. The key is to raise the right amount at each stage to get you to the next milestone. So why would you raise money instead of just growing from your sales? The obvious reason, fuel for growth. With more cash, you can hire that brilliant engineer, blitz your marketing, or scale up production. Basically do in months what might otherwise take years. In fast-moving markets, speed is life. Funding can let you sprint ahead of competitors. That's the competitive advantage angle. Sometimes it's a land grab, and whoever grows fastest wins the market. Picture two startups like rival ride sharing apps. The one that raises a war chest can expand to 100 cities, while the bootstrapped one is still scraping behind just 3 cities. Money can be a weapon. Also, some big visions simply need capital just to get off the ground. If you're building a new electric car or a cure for cancer, you're not doing that on weekend savings. You need labs, manufacturing, talent, which means serious cash up front. And here's the flip side. Raising money isn't automatically the right move for everyone. If you can reach key milestones on your own steam, you'll retain more ownership and control. External money always comes with strings and expectations. I've seen companies raise money just because everyone else was, then regret it when they realize they could have grown slower but steadier and kept their company fully theirs. So ask yourself, do I truly need outside capital to achieve my next big milestones? Or can I hustle my way there and keep my equity intact? The answer will be different for every startup. Time to talk about the price tag of raising money. And I'm not just talking interest rates. When you take on investors, you're giving up a few things. First, dilution. You own less of your company than before. If you had a whole pie and you sell me a slice, your piece gets smaller. Ideally, the pie gets much bigger in the end, but in the meantime, you've diluted your ownership. The founders often go from owning 100% at the start to maybe 60%, then 30%, sometimes single digits by the time the company is mature. That can be fine if your 5% is worth $50 million one day, but it's a shock if you don't understand it going in. Next, control. Investors, especially venture capitalists, don't just hand over cash and say, see you in 5 years. They will likely want a board seat or at least regular updates and certain rights to influence big decisions like approving a budget or a CEO hire. Your startup becomes a bit less your baby and a bit more of a team effort, which can be good or bad. Also, welcome to performance pressure. The moment you take that check, a countdown timer starts. Investors expect growth and fast. If you're not hitting the agreed targets or milestones, you'll be having some uncomfortable conversations, or they might even pull back on future support. Finally, note that not all money is smart. A bad fit investor might push you in directions you don't want, like hyperscaling when maybe a slow build is better, or focusing on the wrong product features. Worst case, they can replace you as CEO if things really derail. It's happened to founders before. So remember, the cash is not free. You're entering a business marriage with your investors, so pick wisely and know what you're trading away. Let's flip the script for a minute. Put yourself in an investor's shoes. They're not ATMs or charity sponsors. They're in this to make money, ideally a lot of it. That means they need to believe your startup could give them a big return, like 10 times or more what they put in, because plenty of their other investments will flame out. They're basically hunting unicorns, those rare startups that can grow huge. So when you pitch, they're measuring risk versus reward. They're asking, is this the right team to pull this off? Is the market big enough to make it worth the ride? Has this founder shown any evidence that the idea works? Maybe a prototype or some user traction. What's the competition? Can this little startup fend off or outrun others? They will scrutinize everything. That's why you might get peppered with questions about your business model, your go-to-market plan, even your personal background. And reality check, most investors say no to almost everything. VCs might see 1,000 pitches and invest in maybe a handful per year. Angels are a bit more lenient, but still careful. They have a portfolio, a basket of startups, and they expect most to fail, a few to break even, and one or two to be massive wins. So they're picky. Here's a fun exercise. Ask yourself honestly, if this weren't your idea, but someone else pitching it, would you invest your own hard-earned savings in it? Why or why not? If you can figure out what might give you pause, you can bet investors will have the same questions. Thinking like them will help you address their concerns head on, which increases your chances of getting that yes. Let's look at a few real-world tales to hammer this home. First up, MailChimp. 2 founders in Atlanta, no Silicon Valley VCs, no fancy pitch decks. They bootstrapped a simple email marketing product from a side hustle into a full-fledged business. It took them about 20 years, but guess what? When they sold MailChimp in 2021, it went for $12 billion, and the founders kept every penny because they never took outside money. That's the tortoise in our story. Slow and steady, but huge payoff in the end. Now the hare, Airbnb. Those guys tried to raise money in 2008 and got laughed out of rooms. Who'd invest in strangers renting your mattresses? So they maxed out credit cards and even sold gimmick cereal boxes to stay afloat until Y Combinator gave them a shot. With that early funding and mentorship, they tweaked their model and started to take off. Then they raised VC rounds from Sequoia and others, fueling their expansion to basically every country on the planet. Airbnb is now a publicly traded company worth tens of billions. And yes, the founders own a smaller percentage than if they'd bootstrapped, but a smaller slice of a gigantic pie. Different path, also a huge success. And then there's WeWork, a cautionary tale. WeWork raised truckloads of cash, over $10 billion at sky-high valuations in a frenzied push to conquer the office rental world. But all that money masked a flawed business model and some, shall we say, questionable leadership decisions. When reality caught up, the company's value crashed and the IPO was pulled, leading to the CEO's ouster. It's proof that throwing money at a bad business doesn't make it good, it just blows up bigger. The moral: there's no single right way to fund a startup. The bootstrapping can work, VC funding can work, and both can also go wrong. The key is to be intentional about what you choose and why. Align your financing strategy with your startup's needs, your growth pace, and even your own style of running a business. It's your journey. Just make sure you're choosing the path with open eyes. You've just drunk from the fire hose of financing basics, so let's recap the essentials. Money is often the make or break factor for startups, and now you know the major ways to get it. From bootstrapping on your own dime to courting angels and VCs with deep pockets. Each option has its pros and cons. Keep control but grow slower, or turbocharge growth but give up a chunk of your baby. The golden rule: there's always a catch. Whether it's equity, control, or expectations, there's no free lunch in this game. But if you play it right, the funds you raise can turn your startup from a scrappy underdog into an industry leader. It's all about aligning funding with your strategy and going in with eyes wide open. Now that we've set the stage, it's time to dig into the nuts and bolts. In the next module, we'll get into the core mechanics of how deals actually work, the stuff that separates the newbies from the savvy founders. We're talking dilution, cap tables, safe notes, term sheets, valuations, all the fun fine print that can decide your fate. Stick with me and you'll learn how to navigate those details like a pro, so you won't get fleeced when the term sheet lands on your desk.